Welcome to the Selftax YouTube channel. If you're an expat, business owner, or landlord, this channel is for you. We simplify tax rules, deadlines, and updates so you can stay compliant without the stress. Subscribe and stay informed. One of the most effective ways to reduce your rental tax bill is knowing exactly which expenses HMRC allows you to claim. And with MTD for income tax now requiring many landlords within scope to keep digital records of income and expenses throughout the year, getting this right from the start matters more than ever. In this video, I am going to go through every main category of allowable expenses landlords can claim in 2026, the ones HMRC will not accept, and one specific rule that trips up thousands of landlords every year. Every allowable expense for landlords sits under one rule. HMRC only permits deductions for costs that are wholly and exclusively incurred for the purpose of renting out a property. If an expense has a personal element, it fails that test and cannot be claimed in full. However, where a cost has both business and personal elements that can be clearly separated, HMRC allows you to claim the business proportion only. If you cannot clearly separate the two, the entire claim is disallowed. That rule applies across every expense category we are going to cover. Repairs and maintenance are among the most commonly claimed expenses and also the most commonly misunderstood. HMRC allows costs that restore a property to its original condition. This includes fixing leaking pipes, repairing electrical faults, redecorating, replacing broken windows like for like, boiler servicing, and damp proofing. What HMRC does not allow as an expense is improvement work. If the work enhances the property beyond its original condition, adds value, or upgrades it significantly, that is generally treated as capital expenditure rather than a deductible revenue expense. The line between repair and improvement is one of the most common points of dispute in landlord tax. Fees paid to letting agents or property management companies are fully allowable. This covers tenant finding fees, rent collection charges, full management fees, tenancy renewal costs, and inventory fees. These are direct costs of running your rental business, and HMRC treats them as standard deductible expenses. If your agent charges a percentage of monthly rent as a management fee, the full amount is claimable as an allowable expense. Buildings insurance, contents insurance, and landlord liability insurance are all allowable expenses. Rent guarantee insurance is also allowable where it is taken out specifically to protect rental income. The premiums must relate directly to the rental property and not include any personal cover elements. If your policy covers both a property you let and a property you live in, only the rental property proportion is claimable. This is the expense category that causes the most confusion, and it is essential to get it right. Since April 2020, residential landlords can no longer deduct mortgage interest directly from rental income as an expense. Instead, under the rules introduced by Section 24, you receive a tax credit equal to 20% of your finance costs. This means higher rate taxpayers receive less effective relief than they did before 2020. Finance costs such as mortgage interest and certain loan-related fees are generally relieved through the basic rate tax reduction rather than as a direct deduction. What you cannot claim is the capital repayment portion of your mortgage. Only the interest, not the capital. Professional fees directly related to your rental business are allowable. This includes accountancy fees for preparing your rental accounts and tax return, and legal fees for matters such as drawing up tenancy agreements or pursuing rent arrears through the courts. What is not allowable is legal fees connected to purchasing or selling a property. Those are capital costs and sit outside the allowable expense rules. Similarly, legal fees for the initial granting of a lease of more than 1 year are not allowable. If you let a furnished property, you cannot claim the initial cost of furnishing it as an expense. However, when you replace items, HMRC provides the replacement of domestic items relief. This covers replacing sofas, beds, carpets, curtains, white goods, crockery, and cutlery. The replacement must broadly replace the function of the original item being replaced. If you replace an item with something significantly superior in value, only the cost of a like-for-like replacement is allowable, not the full cost of the upgraded item. This relief applies only to replacement, not to the initial purchase. Travel expenses for property management purposes are allowable, including journeys to inspect a property, meet contractors, or oversee repairs. If you use a personal vehicle, HMRC's approved mileage rate of 45 pence per mile for the first 10,000 miles applies, and 25 pence per mile after that. Other allowable expenses include stationery, phone costs attributable to the rental business, landlord licensing fees under selective or additional licensing schemes, membership fees for recognized landlord associations, and the cost of MTD-compatible software used for your rental business. Equally important is knowing what HMRC will not accept. Capital expenditure, meaning work that improves rather than repairs, is not allowable against rental income. The full cost of purchasing a property is not allowable. Legal fees for buying or selling a property are capital costs, not expenses. Any personal costs with no clear connection to the rental business are not allowable. The initial cost of furnishing a property is not allowable, only replacements under the relief covered earlier. And your own time or labor spent working on the property cannot be claimed as an expense. So what allowable expenses can landlords claim under MTD in 2026? Repairs and maintenance that restore rather than improve. Letting agent and management fees in full. Insurance premiums for the rental property. Finance costs as a 20% tax credit, not a full deduction. Professional fees directly related to your rental business. Replacement of domestic items on a like-for-like basis. Travel at approved mileage rates and other directly related running costs. Under MTD, landlords within scope must keep digital records of income and expenses and assign categories correctly using compatible software throughout the year. Getting the categories right from the start means your quarterly updates are accurate and your final declaration reflects your true tax position. Next up, how to sign up for MTD for income tax and what the registration process actually involves. Thanks for watching. Subscribe to Selftax for clear practical UK tax guidance. Stay informed, stay compliant, and stay one step ahead of HMRC.